Luckily, I found a real example that perfectly shows how waiting for the right structure and getting the confirmation can make all the difference. Without wasting any time, let's get started. An indicator is said to be showing divergence when the indicator does not follow the direction of price action. MACD indicator in particular is pretty effective at highlighting divergence due to its ability to track rapid shift between the fast and slow moving averages. In the rest of this video, I will break down using a simple step-by-step strategy to spot this pattern very clearly. For a bullish breakout, our first step will be to establish that the market is in a clear downtrend. Let's start by bringing up a clean daily chart for Apple stock. We can clearly see a bullish run that peaked near the mid of 23, but after that the price structure changed. It started forming lower highs and lower lows where the market has already pushed lower. That context gives divergence more meaning because we are looking for the momentum to fade as the trend weakens. Now that we have established our first condition, we will start looking for MACD divergence. Let's watch closely. We get two important price lows here. If we look closely at this, the second low is lower, continuing the downtrend. But here's the catch. Let's move our attention to the MACD line. It's forming a higher low. So if we see that the price has formed a lower low, but the indicator did not follow that trend and formed a higher low, this is regular bullish divergence. On the other hand, a bearish divergence is just the reverse. The price forms a higher high, but the MACD forms a lower high, signaling that upward momentum is weakening and a trend reversal may be setting up. This is a classic signal where price is still falling but momentum is starting to take cover. At this point the setup looks promising and we have got a divergence in place. Our setup is far from over. People often make this mistake when they spot a divergence and enter a trade. A divergence on its own can be misleading, so we need Confluence. First, let's draw a Fibonacci retracement from the swing low in early 23 up to the peak point in late 23. I can see that this second price low is happening right around the 38.2 retracement zone, which is typically a strong support zone in trending markets. Next, I will add the ADX indicator, and what we see here is that ADX is trending down and sitting below the 20 mark, which tells me that the strength of the downtrend is fading. So far, things look good. I will add my final layer, the 50 period moving average. At the time of the second low, price is well below the moving average line and the moving average is still sloping downwards. This tells me that the trend structure hasn't shifted yet. Even though momentum is slowing, the trend is still in control. This is where I'll take a pause and reassess that did I go wrong with spotting my divergence and I should not enter the trade because the confluence has failed. So let's take a step back and see where did we go wrong in our setup. So instead of entering the trade, I will wait. I keep watching for another divergence. I get a third low. At this point, when I compare the MACD lows, it's still forming a higher low, which means the divergence is still holding. Now let me recheck the confluence. Price is now hovering around our retracement zone. The ADX is still weak, but the key point now is that the price is starting to challenge the 50 moving average and the slope of the moving average itself almost slope upwards. This time all pieces are lining up and this is our cue that we need to now move to our next step. Our next step is the MACD crossover. I'll wait for the MACD crossover and when the MACD line moves above the signal line, this happens just after the third low and it's a clean upward crossover. Even better, the crossover happens below the zero line, which statistically carries more weight. Another thing I'm watching here is the angle of the crossover. A sharper slope suggests stronger momentum. And in this case, both the MACD line and the signal line are curving upwards together. Especially the signal line following the MACD line upwards shows strong internal momentum. So finally, we are ready to open our trade. I prefer to enter the trade at the first candle that closes above the consolidation zone after the crossover. For stop loss, I place it just below the swing low for the third low. This keeps the risk tight in case the setup fails. Once the momentum starts building, I will trail my stop using the moving average line or the higher swing lows, and I would target previous resistance level at the profit zone. I hope you enjoyed this video. Kindly share your thoughts and questions in the comments below.